So welcome everyone. Welcome to this revision of SRE 2400. So in this revision, we are going to cover all the concepts along with the questions. And for this, we'll also be referring to our board notes. So these board notes you can join and download from our Telegram channel. The link to the Telegram channel is there in the description. Are you people ready? Yes, sir, we are ready. So without much ado, let's begin with this revision. Make sure you like this video so that it can help out more CA final students. First of all, when I talk about review of financial statements, let's understand the basics. Sir, here also we give our assurance on the historical financial information, but the assurance is limited. That means it is lower than audit. Okay, sir. Now, the engagement risk, it will be reduced to an acceptable level, not acceptably low level, but to an acceptable level. Because it is reduced to an acceptable level, obviously the engagement risk is greater than a reasonable assurance engagement. Now, sir, if I talk about audit, in audit, what was the flow? Audit procedures, sufficient and appropriate audit evidence, and then you used to draw reasonable conclusion. Here you will perform limited procedures, that is inquiry and analytical procedures mainly, so that you can get sufficient and appropriate evidence, that is SAE, and you can draw limited conclusion. So limited procedures, sufficient and appropriate evidence, limited conclusion. Okay. Two review engagement standards are there, SRE 2400 and 2410. In this video, we are going to focus on 2400. Okay, SARI 2400. How do we remember it? The game is very simple. What is the right age to wear a sari? Say 24 year. Sari age is 24 years. So sari 2400. Okay, sir. Now, Baba, understand one thing. In SARI 2400, the engagement to review the historical financial statement, the speciality is that the person who will perform the engagement, that is the practitioner, is not the auditor of financial statement. He is some other person who is reviewing the financials. Okay. Now the objective is, in audit, what was the objective? Reasonable assurance that the financial statement as a whole are free from material misstatement, so that we can form the opinion that financial statements are prepared as per applicable FRF, and then we can report and communicate. Using it, the similar approach, we will form the objective of SRE 2400. Instead of reasonable, what we will say? Limited assurance. So limited assurance via inquiry and analytical procedure that financial statements are free from material misstatement, so that we can express a conclusion that financial statements are prepared as per applicable FRF, and ultimately report and communicate on the financial statement. So this basic thing you just need to understand. Okay, sir. Now we have divided this standard into three parts: engagement, acceptance, performing, and reporting. Before I start with engagement acceptance, just let's overview from the book what all we have covered till now. The basics of review engagement we have already covered. Now, again, like other financial statements, these financial statements can also be as per general purpose, special purpose framework. Okay, sir. Now, let's cover this example given by ICI. There is a Roma Limited which entered into a contract with Dorma Limited. There is a condition in the contract that Roma Limited is required to get the financial statement reviewed for a year on a quarterly basis as per the financial reporting provisions of contract. Can I say this is a special purpose framework? Yes, sir. CRC, TER, creditor, regulator, contractor. Whenever financial statements are prepared as per contract provisions, this is a special purpose framework. So can the financial statements be reviewed from a professional accountant in practice? Yes. As per SRE 2400, financial statements as prepared as per special purpose framework can also be reviewed by a professional accountant. There is no problem. Okay, boss. Okay, sir. So I hope the basics still here are clear to all of you. Yes, sir. Now let's talk about the engagement acceptance. Factors affecting the acceptance and continuance of a client. It says don't accept the client. Don't accept the client. मैंने कहा when should I not accept the client? First of all, whatever information that you need to perform the review, it is unavailable. Even if it is available, it is not reliable. So if you can't rely on that information, why to accept the review engagement? Second point, you have a doubt over the management's integrity. You feel they are dishonest. So when you can't believe in them, Why to accept the review engagement? Don't accept the review engagement. Management or TCWG are imposing a limitation on scope. Limitation on scope means they are not letting you collect the sufficient and appropriate evidence. Maybe they are not letting you send some external confirmation. They are not giving you access to the records. Anything can be there. And the limitation on scope is so vital that it will ultimately lead you to disclaim your conclusion. That means you'll not be able to give your conclusion. Should you accept the review engagement? No, sir. Then it says relevant ethical requirements, including the independence, you are not able to satisfy. Again, you should not accept the review engagement. And lastly, it says you are not satisfied. Sir, we are not satisfied about what? That there is any rational purpose or logic of doing such review engagement. Because you feel there is a significant limitation on scope, you feel that they will use the practitioner's name in an inappropriate manner. And the third thing is engagement wants to comply with law regulation, but law regulation requires audit. So get the audit done. Why are they getting the review done? So you feel there is no rational purpose of doing such engagement. Or you are not satisfied that the review engagement would be appropriate. So you feel the review engagement is not appropriate. So you can suggest some other engagement. So other engagement means another type of engagement can be audit. Oh my God. It can be audit if they want some assurance. But if they don't want an assurance engagement, then you can prepare the financial statements for them. It can be a compilation engagement. Okay. So this is the answer that ICA can ask you. What are the factors affecting the acceptance of a review engagement? And then they may require you to write these 5 to 6 points. So I hope the points are clear. Yes, sir. So I will give you a short technique to properly remember these points in a good fun manner. I say that don't accept the review engagement if in loser say you are not satisfied. Come on, say with me. In loser means you're talking about management and TCWG. That in loser say you are not satisfied. Now the question is, what is in loser say you are not satisfied? So let's map the points quickly. In means that the information needed is unavailable or unreliable. Second in means management's integrity, you have a doubt over it. Okay, sir. So information needed is unavailable, unreliable, doubt over management's integrity. Loser means LOS means there is a limitation on scope which will lead to disclaimer of conclusion. Means ethical requirement including independence, you are not satisfied. And lastly, not satisfied means you are not satisfied that there is a rational purpose, or you are not satisfied that the review engagement will be appropriate. Sir, not satisfied about the rational purpose. When does a person's rational purpose get affected? Because you need to learn these 3 points also. Tell me, when is a person's rational purpose get affected? You are no more rational in your thinking. Sir, when you drink ml beyond your limit. When you drink ml beyond your limit, your rational thinking goes away. So ml beyond the limit means when more than the limit you take ml. So limit means limitation on scope. ML means manner. They are going to use your name in an inappropriate manner. And L means you are doing the review engagement because of the law regulation, but law regulation requires audit. Okay, so rational purpose say you are not satisfied. And lastly, because you are not satisfied, so you will say review engagement is not appropriate. Let's do some another type of engagement. Are all the points clear? Yes or no? Yes, sir. So if you want, you can just pause the video for 1 or 2 minutes, properly revise all the points, and then go ahead to the next topic. Okay, sir. So with this, the first topic that comply with the ethical requirement and engagement level quality. So you need, like every engagement, you need to comply with the ethical requirements, independence, and engagement partner will be responsible for quality. Factors affecting acceptance and continuance. This we already covered. You can just take a quick read from here. Now let's move to the next topic, preconditions for accepting a review engagement. I think this topic was asked in your May 25 exams. Oh my God. Now, sir, what are the preconditions for accepting a review engagement? You people tell me. Is it a new topic or the same that we cover in audit? Sir, same that we cover in audit. In audit, what were the points? First of all, management's preconditions means, first of all, you fulfill these conditions, then we will accept the audit. So before audit comes, pre means before. Before audit comes financial statements. Before the financial statements come FRF. So first thing that you need to check in precondition every time is FRF, that the FRF should be acceptable. Whatever is the applicable FRF, that should be acceptable. So determine that the FRF is acceptable, and if they are prepared as per special purpose financial statement, you need to understand the purpose and the users. Then you enter into a management agreement, that they understand and acknowledge their responsibility. What is the responsibility? First of all, financial statements. Unless financial statements are there, what will we review? So preparation of financial statement as per the applicable FRF. Now for the financial statements to not have any material misstatement, they implement internal control. Everyone, internal control. So for such internal controls, so that the financial statements are free from material misstatement, whether due to fraud or due to error. Now when financial statements are ready, who will come? Practitioner will come, not the auditor. Here we use the word practitioner, who is not the auditor of the company. Practitioner will come, and you have to provide the practitioner with OW. Sir, what is OW? A for access to all information relevant for the audit of, relevant for the review of financial statements. Okay, sir. Any additional information that the practitioner may ask, and unrestricted access. Say with me, unrestricted access within the entity to obtain the evidence. So all these preconditions need to be satisfied. First of all, FRF is acceptable. Then, sir, management is accepting the responsibility for preparation of financial statement as per applicable FRF. Internal control, so that the financial statement don't have material statement. Now, when the financial statements are ready, provide the practitioner with OW. OW means all information, additional information, unrestricted access. Are these basics clear? Yes, sir. Now, sir, if you are not satisfied, prior to accepting the engagement, you should discuss with the management, and if the terms can be modified as per your requirement, then you can accept. So if you are not satisfied with any of the above matter before acceptance, discuss the matter with management and TCWG. If the changes cannot be made to your satisfaction, don't accept the engagement. If the issues are after the acceptance and you are not satisfied after the acceptance, again discuss. See, whenever you are not satisfied, discuss. Okay, chahe it is before or after the acceptance. Then see whether the matter can be resolved. If it can't be resolved, then you can withdraw. That means you will question your ability to continue with the engagement. If you are not withdrawing, then consider the impact on the report. How to communicate the matter in the practitioner's report. Simple points, sir. Then we covered another topic which was similar to the essay 210, agreeing the terms of engagement. Let's quickly read it through from the book. Okay, easy topic. Agree the terms of engagement prior to performing the engagement, not after performing the engagement. Then agreed terms are recorded in the engagement letter or other written agreement. Whenever there is a recurring review engagement, you need to see whether any circumstances are there which require the revision of the terms. For example, if there is a change in the FRF, you need to change the terms of engagement, or new engagement letter needs to be there. Don't agree to the change in terms unless there is a reasonable justification. There should be proper logic to the change in terms. Now, if prior to the completion of review, they ask you to change the engagement to an engagement where no assurance is provided. No assurance means agreed upon procedure, compilation engagement. Then again, there should be reasonable justification for the same. Okay, sir. Now, if the terms are changed, no problem. Agree and record the new terms in a new engagement letter or other written agreement. So these basics you just need to read through so that your basics are clear. Please tell me any doubt till here. Come on, everyone. Any doubt till here? If no doubt, take 2 sips of water and in the chat box ready. Then we'll cover the next topic. Awesome. Now, sir, we need to perform the engagement. The first part of SRE 24020 is done. Engagement acceptance. This we have properly completed. Now let's discuss about how do I perform a review engagement. So for this, again, come to your notes. There are 4-5 things that you need to cover. First of all, materiality. So materiality, again, why do you need materiality? So that you know what are the items I need to test. And when I am testing and I find a misstatement, then I need to check whether it is material or not. So for designing the procedures and evaluating the results, whether the misstatements are material or not. Again, does the materiality change From audit to review, no. Materiality remains the same regardless of the level of assurance. So same materiality as you would use in audit, same you can use in review. Okay, sir. Similar to the concept of audit, here also you can revise the materiality. On becoming aware of information during the review, if it would have been available before, you would have determined a different amount initially. So if in the final financial statements, revenue figure changes and you are calculating the materiality as a percentage of the revenue, because revenue has changed, materiality figure will also change. So 3 points of materiality. Why do you use the materiality? For designing the procedure, evaluating the results. Second, it remains same regardless of the level of assurance. And third point is revision of materiality. Then, sir, risk assessment procedures. Risk assessment procedure means understand the entity environment so that you can identify what are the areas with risk of material misstatement. And then we started with the main procedure, that is inquiry and analytical procedure. First of all, inquiry is an important topic. Please focus here. Okay, sir. In how many stages did we divide inquiry? Do it. 4 stages, sir. 4 stages we divided the inquiry process. First stage is collecting the information. Do with me. Collecting the information, seeking information. So seeking information from management and others within the entity. It can be non-financial as well as financial. Now, sir, the financial matters are just a game of the standards. 240, 540, 550, 560, 570. Come on. 240, 540, 550, 560, 570. 240 fraud. 540 accounting estimates. 550 related party. 560 subsequent events. 570 going concern assessment. Events and conditions that may cause significant doubt on entity's ability to continue as a going concern. So all these points you can do the inquiry that you already study in audit. Okay, sir. Now, once you have collected all the information, what will you do? Sir, we will evaluate the response. In the first stage, you seek information. In the second stage, whatever information you have got, you need to evaluate it. So evaluate the response of the management. This is also part of the inquiry process. Third stage, you can also inquire about the actions at the meetings of the owners, TCWG committees, communication from the regulatory authorities and other matters. What can I get to know about the meetings and communication from regulatory authorities? Sir, you can get to know about any non-compliance with laws and regulations, litigations and claims from all these inquiries. Plus, if you find any inconsistency means there is a penalty notice for which no provision is created. Then you can do further inquiry. And now when you are doing further inquiry, check the management's response considering other procedures, knowledge and understanding of the entity. So these are the 4 points to be covered. Acha, first 2 points are easy. Seeking information, financial, non-financial. And then evaluating the response. But third point, now most of us forget. So who helped us remember the third point? Tell me. Sir, Neeraj's wife. Neeraj's wife, na, she doubts him a lot. So one day what happened, na, Neeraj was coming late. Because Neeraj was coming late, so what happened was, his wife asked, where were you? So Neeraj said, Kina, there was a meeting. And after the meeting, when I was running late towards the house, my car met with a problem. So police person stopped us and police person made a challan. Okay, sir. Now when all of this was happening, so wife will inquire about what? Wife will inquire the action at the meeting. Ki what happened at the meeting? Neeraj, tell me. Then she will inquire, police wala gave you a challan, show me the challan. Communication from regulatory authority. So these 2-3 points she saw. Acha, when Neeraj went to take bath, his friend called him and friend said, yeah, today to we enjoyed a lot. It was so fun. Can I say friend's call is creating some inconsistency? Neeraj to said he was at the meeting. Friend's call is like he was enjoying somewhere. So there is some inconsistency. Now when there is inconsistency, she will do further inquiry with the Neeraj. And then she can also do some other procedure. She can ask the friend, where were you? What were all of you doing? Okay? And then she will also consider the knowledge and understanding of the Neeraj. How has been he before and whether he is lying or not. So these 2 points, because most of the time we tend to forget them, in this fun light manner you can just remember. Further inquiries about action at the meeting, communication from regulatory authorities, other matter. And the last point, when there is a inconsistency, she can do further inquiries. Further inquiries can can be done on inconsistency, and then whatever is the management response, evaluate in the light of other procedures and knowledge and understanding of the entity. Simple points, simple, sir. So if you come to your notebook, these points we have already covered. Everyone, please tick mark with me. First of all, materiality in designing the procedure, evaluating the results. What is material remains same regardless of the level of assurance. Very good. You can revise the materiality when you become aware of any information that would have caused you to determine a different amount initially. Then risk assessment procedure, all of us understand the entity, environment and applicable FRF to see the areas where the risk of material misstatement are high. Then designing and perform the procedures. This part you just need to read, that try to address all the material items and focus on the areas where the material misstatement likely to arise. That means risk of material misstatement is high. Inquiry and analytical procedure along with procedures to address specific circumstance. What are these? We are just going to revise it. Then you can also perform other procedures like reading a contract of the entity. But don't worry, you are still trying to obtain limited assurance only. It is not a reasonable assurance. Now for inquiry, we divided it into 4 stages. Last time, let's revise. Revision in revision. Seeking information from the management and other persons. It can be non-financial and financial. Financial is 240 fraud, 540 accounting estimate, 550 related parties, identification of related party, 560 subsequent events, event between the date of financial statement and report, 570 basis for management going concern assessment and event and condition that cast doubt on going concern. Okay, sir. Second stage is evaluating the response by the management. Third stage, Neeraj wife inquire about the actions taken at the meetings, communication from regulatory agencies, other procedures. If any inconsistencies there, she will do further inquiry and check the management's response considering other procedures and knowledge and understanding of the entity. Are all the points now clear? Yes, sir. For analytical procedure, there should be adequate data to do the analytical procedure. Now comes the favorite question of ICI. Why the inquiry and analytical procedures are important? Take 2 sips of water and get ready. Why are inquiry and analytical procedures important? Sir, inquiry helps us to understand management's intent. Inquiry helps us to understand the intent. Acha, is understanding the intent very easy or you need to collect some information? Sir, information to support the management intent is not easily available. We need to inquire about para. Para means past history, reasons, and ability. For example, if you want to check management intent is true or false. So let's say they have created a provision for bonus of 15% of the profit. So check the past history. In past also they have declared such bonus. Okay, sir. Then the reason, has the company performed very well? And the ability, do they have so much cash in the bank to declare such higher bonus? So these 3 things you need to check: past history, reasons, ability. Say with me, past history, reasons, ability. If these 3 things are there, that means management's intention is right. So the first part of the inquiry, importance of inquiry, is in for inquiry helps you to understand in for intent. Now the information may be limited, so you can understand the management's para. But Baba, be alert. Management can still lie about their past history, so apply professional skepticism. And lastly, inquiry can help you to understand the entity environment to identify areas with risk of material misstatement. Okay, sir. Last point of the inquiry becomes the first point of analytical procedure. So now coming to the importance of analytical procedure, just move in the flow with me, focus on the board. Understand the entity environment to identify the areas with risk of material misstatement. Now, what are the areas with risk of material misstatement? Wherever there is an inconsistency or variances from the expected trends or financial statement value. Now, sir, whenever we find an inconsistency or variance, we will perform additional procedure. So, third point says additional procedures on the matters where you believe that the financial statements may be materially misstated. When you perform extra procedure, you get extra evidence, corroborative evidence, supporting evidence to the inquiry analytical procedure already done. So, these 4 points you just need to do in the flow. Understand the entity environment to identify areas with risk of material misstatement. What are such areas? Wherever there is an inconsistency or variances from the expected trends. If the things are going as per trend, no problem. But when they move away from the trend, this is an area of problem. Here you need to do extra analysis, additional procedure. So additional procedures and corroborative evidence. Okay, okay, sir. Example of analytical procedure, month on month analysis of the revenues and cost. Are all the points clear? Yes, sir. So these are the points which make the inquiry and analytical procedures important. If you come to your book, you will find the same points. In for inquiry helps you to understand the management intent. Information to support the management intent may be limited. So understand the management's para. Para means past history, reasons and ability. Okay, sir. At such time, be alert, apply professional skepticism to evaluate the management's response. Plus, it also assists in obtaining and updating the understanding of entity environment to identify the financial statement areas where material misstatement likely to arise. That means high risk of material misstatement. Last point of inquiry becomes the first point of analytical procedure. Understanding the entity environment, financial statement areas where the material misstatement likely to arise. What are such areas? Inconsistency or variances from expected trends or values. Here you do additional procedure, collect corroborative evidence. Example is month on month analysis of the revenue and cost. Okay, sir? Okay. Now we move to the next topic, procedures to address specific circumstance. Tell me one thing. In this topic, did we discuss anything new or it was a revision of the standards on auditing? Did we cover anything new or just a revision of standards on auditing? Just a revision of standards on auditing. So this topic we are going to quickly revise from the chart. I think this should be enough. And then we will do a cute question on this topic. Okay. Everyone please focus on the chart. First of all, procedures for related parties. Here you need to stay alert to related party relationships or transaction that the management has not identified or identified but not disclosed to the auditor. Now, if you find significant transaction outside normal course of business, that means that are not at arm's length price, then you need to inquire the management about three things: nature of the transaction, any related parties involved, and business rationale of the transaction. What is the logic of the transaction? So for related party, two things to be done: stay alert to the related party relationships or transaction that management has not identified or not disclosed. When you find significant transaction outside normal course of business, inquire the management about three things: nature of the transaction, are related parties involved, and what is the business rationale of the transaction. Okay, okay, sir. Then we discussed about fraud or no clar. Whenever you get an indication, communicate to TCWG senior management. Then see the assessment. Request the management assessment of the financial statement effects. Then see the effect on two things. Sir, two things what? First of all, on the, just give me a moment, on the conclusion, whatever conclusion you are framing in the report, you need to see the effect on that. Plus, is there any need to report to an outside party about the fraud or no clar? So easy thing, communicate to TCWG senior management and then see three effects: financial statement effects, effect on the conclusion, effect on reporting to any outside party. Easy, sir. Then going concern. Assess the entity's ability to continue as a going concern. If you identify any event or condition that casts significant doubt on the going concern, then inquire the management's plans. Are these plans feasible? Are they going to improve the situation? Okay, sir. Then you need to evaluate the results of the inquiry, whether they provide sufficient basis to believe that financial statements can be prepared on going concern basis, there is no problem. Or financial statement should not be prepared on going concern basis, there is a material misstatement. So this going concern basis wala point is also very important. First of all, assess the ability of entity to continue as going concern. When you are assessing that, and if you identify any event or condition that casts significant doubt on the going concern, inquire the management's plans, whether they are feasible, whether they will improve the situation. Then when you are doing this inquiry, you will evaluate the results of the inquiry, whether they provide sufficient basis to believe going concern basis is appropriate or going concern basis is not appropriate. Easy peasy, sir. And the last point was considering the work performed by others. If you are using the work of an expert not in the field of accounting or assurance, check that the work is adequate. Plus, you can also consider use of other people work in the review of group financial statements. Done, sir. Now let's do a question on this topic. I think we have question number 2. Let's see what does the question number 2 talk about. A review of financial statement includes the consideration of entity's ability to continue as a going concern. If during the review we become aware of events or condition that cast significant doubt on going concern, what are the steps to be taken? So first of all, write the SRE 2400, engagement to review historical financial statement. Okay, sir. How do I get to know it is SRE 2400? Clearly written that there is a practitioner, not the auditor. Now, sir, whenever you get to know about the events or condition, we will inquire the plans, their feasibility, and whether it will improve the situation. Then evaluate the result of the inquiry to see whether it gives a sufficient basis that entity can continue to present the financial statement as per going concern basis, or whether the financial statements are materially misstated considering the going concern accounting. Whatever conclusion you draw, it should be in light of the information that you know as a part of the review. Please tell me procedures for specific circumstance. Are these procedures crystal clear? Yes or no? Any doubt, anyone? Yes. Come on, everyone. Done. Done, sir. Now let's move to the next topic. What was the next topic? If I am getting a feel that there are chances that there can be a material misstatement in that area, should I ignore that area or I should perform additional procedures? What should be done? Should I ignore that area or I should perform additional procedure? Sir, you should perform additional procedure. Whenever you think there is a possibility of material misstatement, to turn that possibility into the actuality, whether in actual there is a material misstatement or not, you should do additional audit procedure. So this is what is covered in the next part. Additional procedures when you feel that financial statements may be materially misstated. So first point says, perform additional procedures to conclude that financial statements don't have a material misstatement or financial statements have a material misstatement. What can be the additional procedure? Our two favorite procedures in this standards are inquiry and analytical procedure. So you can do additional inquiry or analytical procedure, or if you want, you can also do some test of details or external confirmation. Okay, sir. If you are still not able to conclude whether material misstatement is not there or there, continue, Baba, continue performing the additional procedures. Or if you are still unable to continue the additional procedure, then it is a limitation on scope. You are not getting sufficient and appropriate evidence, so you may be required to modify your conclusion. Then in that case, you will have to modify your conclusion. So this is what is given here. Design and perform the additional procedures to conclude that the matter is not likely to cause the financial statements to be materially misstated. That means material misstatement is not there. Or matter causes the financial statements to be materially misstated. That means material misstatement is there. What procedures to be done depends on the circumstances and professional judgment. Procedures can be additional inquiry, additional analytical procedure. That means with greater detail and focus. or it can be other types of procedure like test of details or external confirmation. Even such type of procedures can be done. This will help you realize whether material misstatement is not there or there. If you are still not able to conclude whether material misstatement is there or not, continue performing the additional procedure. But if you are not able to continue, then sir, there is a limitation on scope and you may have to modify your conclusion. Now we have an example with us given in ICI material. Let's just read this example. Nothing else need to be done. When I was performing my inquiry and analytical procedure, analyzing the data show that material amount of past due debtor for which no provision has been created. So you feel that the debtor's balance may be materially misstated. So I inquire whether the uncollectible debtors should be shown as impaired. Now, sir, based on the inquiry, I will get the management response to believe that material misstatement is not there or material misstatement is there. And the last thing could be that I can continue to believe that debtor's balance is likely to be materially misstated while not providing sufficient and appropriate evidence that in fact they are misstated. So I still feel there is a possibility of misstatement. So here I will continue to perform additional procedure. I can ask for management analysis of the subsequent collection of the debtor. So seeing the subsequent collections of the debtors, I will get to know how much provision is required to be created. So this is what you need to do whenever you feel the financial statement item may be materially misstated. You can inquire from the management. This inquiry will help you get to know material misstatement is not there or material misstatement is there. If you still don't get to know, you will have to perform additional procedure like analysis of the subsequent collection of the debtors. Okay, sir. Then we discussed about subsequent events. Everyone laughed it off. Ha 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 ha. Sir, why? Ha 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 ha. Are Baba, this is a repetition of SA 560. So there are two types of subsequent events. First one between the date of financial statement and the date of audit report. For those subsequent events, you just need to see whether any event require adjustment or disclosure. Just check the same. So if you become aware of events between the date of financial statement and report which require adjustment or disclosure, ask the management to correct those misstatements. Okay, sir. For the events after the report date, do you have any obligation? No. But whenever we get to know something, if it was known before, we go to the management and do DDI. So DDI means discuss the matter with management TCWG, determine if the financial statement need amendment, and if yes, how the management plans to address this matter. Now, if the management does not amend and report is already given to the entity, you will ask them to not give it to third parties. If they still issue without any amendment, take relevant action against them. Okay, sir. Similarly, for written representation, all the content is ditto same as SA 580. Quickly read these basic point. First of all, written representation for management responsibility, preparation of FS as per applicable FRF, fair presentation, all information access to the practitioner, all transactions recorded in financial statement, written representation that they have disclosed to the practitioner. वही same points. 240 fraud, suspected fraud. 250 actual possible non-compliance with laws and regulation affecting the financial statements. Then 550 is related party relationships transaction. 560 subsequent events. 570 use of going concern assumption. Any material contingent liability or non-monetary transactions, these have been disclosed to the auditor. If management is not giving written representation, discuss the matter, re-evaluate the integrity, and if management is so bad, how bad will be the representations and other evidence in general, and then take appropriate action. You can withdraw from the engagement. If withdrawal not possible, disclaim whenever you doubt the integrity or management is not providing written representation. Okay, sir. So here you can say majority of the standard is done. Okay, boss. Okay, sir. Now tell me one thing. As a practitioner, just look at me. Now the standard is just about to get over. As a practitioner, if I feel that management has not given me sufficient and appropriate evidence. What should I do? Should I give up or should I keep on performing my procedures? Sir, you should continue performing your procedure. You should extend your procedures. You should perform other procedures. This is what we covered in the first part. If the practitioner feels he has not obtained expected evidence, sufficient and appropriate evidence, he has not obtained. Okay, sir. From inquiry, analytical procedures, or procedures in specific circumstance, then in that case, you should extend the work or you should perform some other procedure. If this is not practicable, you are not able to get the evidence, then Baba, please discuss with the management or TCWG and see the effect on the report and ability to continue the engagement. Ability to complete the engagement, you need to consider the same. Now, a special case that we covered. If by a specific procedure I don't get the evidence, but through some other procedure I am getting the evidence, is it a limitation on scope? No, it is not a limitation on scope. So these are the basic points that are written here. Everyone please read with me. Practitioner may not have obtained the evidence expected through inquiry and analytical procedure and the procedures in specific circumstance. What were the procedure in specific circumstance? Sir, those SA 550, 240, 250, 570, 620, those procedures that we covered in the chart form. If the practitioner believes that it is not a sufficient and appropriate evidence, then extend the work or perform other necessary procedure. If it is not practicable, you are not able to get the evidence, then sir, discuss with the management and TCWG and consider the effect of limitation on scope. The effect of limitation on scope can be financial statements may be materially misstated, so modify your report and consider the impact on engagement continuance. Inability to perform a specific procedure is not a limitation on scope when you obtain sufficient and appropriate evidence by performing the other procedure. So with this, the standard is almost completed. Now, sir, after this, if you talk about forming the conclusion of financial statements, these topics are exactly same as your SA 700, 705 and 706 that we have covered before. Do you want me to give you a quick overview of this part also in this revision? If you say yes, we will do it. Tell me. Tell me. Yes, sir, we want. So before I give a quick overview, I hope all of you now understand. Acha, in the review part, do we use the word opinion or conclusion? Sir, we use the word conclusion, not the opinion. Okay, sir. If the material misstatement are not there, give an unmodified conclusion. If the material misstatement is there, give a modified conclusion. Okay. Now when I am giving an unmodified conclusion, is it a positively worded opinion or a negatively worded opinion? Negatively worded opinion. What is the difference between positively worded and negatively worded? I'll tell you. So if there is a boy named Mayank. So if I want to say Mayank is a good boy, one way is saying I can say Mayank is a good boy. Second way I can say is nothing has come to my attention. Okay? Nothing has come to my attention to believe that Mayank is a bad boy. So when I say nothing has come to my attention to believe that Mayank is a bad boy, can I say it is another way of saying Mayank is a good boy? Ha, sir. But the second way that I am saying that nothing has come to my attention that Mayank is a bad boy, this is a negatively worded opinion. So in review, because you are not taking reasonable assurance, you are doing limited procedures, limited checking, limited assurance. So you say that the limited checking that I have done now, nothing has come to me to feel that financial statements are not prepared as per applicable FRF. So you will say nothing has come to our attention to believe that financial statements are not prepared in all material respects as per the applicable FRF. You're getting the feel or not? Yes, sir. Now, Baba, the basic points that we covered in audit, these are the same points. First of all, whatever are the uncorrected misstatements, you see whether they are material or not. Then see the qualitative aspects of accounting practices, accounting policies, accounting estimates, disclosure, whether they are adequate or not. Okay, sir. Then if your financial statements are prepared as per fair presentation framework, you need to evaluate the OPSC of the financial statements. OPSC means overall presentation, structure and content, and then see whether they are giving a fair presentation or not. These basic things you just need to take a read, nothing else need to be done. Then for unmodified conclusion, we have already discussed how the opinion needs to be given. You can use either of the phrases. If it is a fair presentation framework, you will say, nothing has come to our attention to believe that financial statements are not prepared fairly in all material respects as per applicable FRF, or the financial statements don't give a true and fair view. If it is a compliance framework, what you will say, nothing has come to our attention to believe that financial statements are not prepared in all material respects as per applicable FRF. Fair word you will ignore. Now, when you give a modified conclusion, I hope you understand, either you have a evidence that there is a material misstatement, or you don't have the evidence about a material area, you give a modified conclusion. Now, three types of modified conclusion are there. DAKU. DAKU means disclaimer, adverse, qualified. Whenever you give a modified conclusion, the heading of the conclusion para changes, and you also need to give a basis. What was the basis of giving a modified conclusion? Okay, sir. Now, when the financial statements are materially misstated and you have evidence, if you feel the impact is material but not pervasive, you give a qualified conclusion. But if the impact is material and pervasive and you have the evidence, you give a adverse conclusion. Same as SS705, nothing new. Then, sir, if you don't have a evidence and you feel that the possible effect of that is material but not pervasive, qualified conclusion. Again, if you don't have the evidence and the impact is material and pervasive, you don't give the conclusion, that is disclaimer of conclusion. In this case, the other option is also available, that you can withdraw from the engagement if it is allowed under the law or regulation. Now, sir, for this withdrawal, as per the law regulation, we have already covered the SEBI part. SEBI part we studied in SS705. So that says that if you are withdrawing within 45 days from the end of quarter, you need to give the review report for that quarter. If you are withdrawing after 45 days from the end of the quarter, you need to give the review report for that quarter and the next quarter. If you have given the review report for 3 quarters, you need to give the review report for whole year. So that is applicable for listed entities review report. Okay, sir. Just the extra knowledge that I shared. That's it. Now, sir, talking about the qualified conclusion. How do you frame the qualified conclusion? Do you say, because of this matter, whole financial statements are bad? Or you say, except for this matter, the financial statements are okay? Sir, in qualified conclusion, impact is material but not pervasive. So you will say, except for this matter, the whole financial statements are okay. So you write your conclusion in this way, that except for the effect of the matter described in basis for qualified conclusion para, again same way, nothing has come to our attention to believe that financial statements are not prepared fairly in all material respects as per applicable FRF, or financial statement don't give a true and fair view. If it is a compliance framework, just remove the fair word. Okay, sir. If the reason for qualified conclusion is that you did not get evidence, so instead of the word effects, what do you use? Arey Baba, if you did not get evidence and you want to give a qualified conclusion, instead of effect, what word you use? Sir, we use possible effect. We use possible effect. Possible effect means that whatever area evidence we don't have, the possible effect can be material but not pervasive. Okay, sir. Then adverse conclusion, we all understand, because of this matter, financial statement don't give a true and fair view. And for compliance framework, you will say financial statements are not prepared as per applicable FRF. Disclaiming conclusion, because of this matter, we did not get the evidence. Because we don't have the evidence, we don't present a conclusion. And this is how you frame your opinion. Now, in the basis for conclusion para, you explain the reason why you modified your conclusion. Again, these reasons are ditto same as what we cover in SS705. First of all, if it is related to amount or quantitative disclosures, that is in the numbers, explain the misstatement, quantify the misstatement unless it is impracticable. If it is narrative disclosure, that is the wordings. Again, you explain the misstatement, how the disclosures are misstated. Now, sir, omitted disclosure, disclosure is not there. Explain that there is an omission. Talk about that omission, the nature of the omitted information. Now people are curious to know what is that omitted information that management is not showing. So unless prohibited by law regulation, you can include that omitted information in your report. Okay, sir. And last point is, if you did not get evidence, you need to disclose the reasons. What was the reason that you did not get sufficient and appropriate evidence? Easy, sir. So these basic things are done. Practitioner report I'll just cover at the end. EOM and OM para are exactly same. EOM para is done for what? Draw the attention to a matter that is presented and disclosed in the financial statement. You should also have evidence that this matter is not materially misstated. Okay, sir. Plus, it is fundamental to users' understanding of financial statement. At the heading, emphasis of matter, same as SA 706. Other matter other than presented and disclosed in financial statement, which is relevant to what we used to say audit, auditor responsibility, audit report. Here we will say it is relevant to review, practitioner responsibility and practitioner's report. And it will be other matter para. Documentation, same as audit, or procedures, evidence, conclusions, significant matters, significant professional judgments, who did the work, who performed the review of the work, date of work, date of review, these things to be documented. And if on significant matters you had some discussions, you can document those discussions. Now, sir, what is the difference between audit and review? First difference is about the assurance. In audit, it is a reasonable assurance. Review, it is a limited assurance. Then for that assurance, what is the cycle you can talk about? In audit, what procedures you perform? Elaborate procedures. So test of control, substantive procedures. What evidence you get? Sufficient and appropriate evidence, and you draw reasonable conclusion. And then you give a positively worded opinion. If I talk about review, we perform fewer procedures, inquiry, analytical procedure. We get sufficient and appropriate evidence to draw limited conclusion. Then for limited conclusion, we give a negatively worded conclusion. Negatively worded conclusion. That's it, sir. So with this, the whole standard is done. Talking about the practitioner's report, you can just take a read. All the points that we talk about in audit report, same points you will find here. Only one point is different. On that, there is also a question in the question bank that we are going to do properly. First of all, title, independent practitioner's review report. Addressee, talk about the financial statements, notes to accounts, date and period covered by financial statements. These basic things come in every review report. Then the management's responsibility for preparing the financial statements, internal control, providing full information to the auditor. Practitioner's responsibility for giving a conclusion and doing the review as per this SRE. Then for special purpose financial statement, you can talk about the purpose and the intended users. And if there is a choice of FRF, then how did they choose the acceptable FRF? Okay, sir. The important point was G, description of review and its limitations. First important point is, what is a review? Sir, it is a limited assurance engagement. Okay. So this important point, you need to learn these 3 points properly. Focus here. Description of review and its limitations with the following statement. So first of all, say review is a limited assurance engagement which involves limited procedure. So limited procedures like inquiry, analytical procedure. And because these procedures are limited, they are substantially less than audit as per standards on auditing. So we don't give a audit opinion. So limited assurance, limited procedures, less than audit. So we don't give a audit opinion. Then the points are very similar. How do you give a modified conclusion? Describe the matter giving rise to modification. Date of report, don't sign the report unless financial statements are prepared. Management has taken the responsibility and you have sufficient and appropriate evidence. Then your sign and place of signature. Done, sir. Sir, you said that you will make us do a good question. Yes. So we have question number 1. In a review engagement under SRE 2400, thank you ICA for giving the name of the standard. Practitioner relies mainly on certain procedures. Name the procedure. So what are the 2 famous procedures in review? Inquiry, analytical procedure. Okay. Discuss the importance of this procedure. So importance part we have already covered, the table format that we covered in the class. Now, sir, after this it says report also contains a description of the review and its limitation. What statements are added in the report for the review and limitations? So three statements you need to add: limited assurance, limited procedures, inquiry and analytical procedure. Because these procedures are substantially less than audit, we don't give a audit opinion. We don't give a audit opinion. Okay. Okay, sir. One more topic, one more question. Question number 2. Everyone focus. During the review of financial statements, based on inquiry, you feel there is a possibility of material misstatement. So whenever there is a possibility to know the actuality, you will perform additional procedure. That material misstatement is not there or material misstatement is there. Additional procedures can be additional inquiry, additional analytical procedure, or you can do other types of procedure like test of details or external confirmation. Okay, boss. Okay, sir. So with this, the whole SRE 2400 gets done. I hope all the concepts are crystal clear to you.